In Chapter 14, we're going to be reviewing adjusting entries again. We're going to revisit some that we did already back in Chapter 5, and we're going to look at some new ones that are related to a merchandising business. We'll get right to it. So the first one is the merchandise inventory adjusting entry under the periodic method. So in the example, Andy's Auto Parts had a beginning merchandise inventory balance of $23,000. At the end of the period, he took a physical count of the inventory and found that $27,000 was still on hand. With the merchandise inventory adjustment, it's really important that we locate the beginning balance and the ending balance for the year. Remember, this beginning balance started on January 1st and it stayed on the books all the way until the end of the year. So here we are at the end of the year and we've counted to see what our actual inventory really is. So it's $27,000. So this is a two-step process. We need to remove the old $23,000 from our books and then add the new physical inventory figure that we just counted. To do that, there is a two-step process. The first step is to remove the old beginning inventory figure. So remember, merchandise inventory is sitting there with an old $23,000 debit balance. So to remove the $23,000 debit from merchandise inventory, we're going to credit the account for $23,000. So that will bring merchandise inventory to zero. Then as the offset to the $23,000 credit, we're going to debit income summary for $23,000. Now in step 2, we're going to insert the new balance. So to do that, we're going to debit merchandise inventory for the new figure, which is $27,000, and then credit income summary. So just keep in mind, if you are adjusting merchandise inventory, it is a two-step process. The first is to remove the old number, and then the second step is to insert the new number. The next adjusting entry is another inventory adjustment. A separate inventory is kept on the balance sheet for inventory that's been returned from customers. So the inventory adjustment is very similar to the normal inventory account. We remove the old number first, and then in the second entry we enter the new estimated balance. In the example, we have an estimated returns inventory balance of $2,000 before the adjustment. The actual estimated balance should be $3,000. So in the first step, we're going to remove the old balance of $2,000 with a credit to estimated returns inventory with an offsetting debit to income summary. And in the second entry, we're going to add in the new estimated figure. So there we will debit estimated returns inventory for the new figure or the new estimate of $3,000, and then offset that debit with a credit to income summary. Now the worksheet entry for the inventory accounts and the adjustments looks a little bit different from what we've seen before. So what you have to remember is you're going to have in each inventory entry a debit to income summary and a credit to income summary, and they'll be on the same line. Well, you will carry both of those balances over to the worksheet. And the first number will represent the beginning balance, and then the second number will represent the ending balance. So when you're calculating your cost of goods sold, you can easily identify which is the beginning and which is the ending. So let's look at that. Here is just a partial picture of a worksheet starting at merchandise inventory. So here's the trial balance with the old figures. Okay, remember the first step in our adjustment was to remove the old figures. So here are the credits from the two adjusting entries. And then we debited to insert the new balances. So here are the new balances. So when we have a debit of 23 and a credit of 23, we get a zero balance, and then what's left is the new balance that's carried over to the adjusted trial balance. And the same thing happens with the estimated returns. 2,000 debit and a 2,000 credit offset one another, give you zero, and what's left is the $3,000 debit carried over to the adjusted trial balance, and then that we'll carry those over later to the balance sheet. Now let's look at income summary. Look, notice that you've got two adjustments here on the income summary line, both for both inventories. So we're not going to net those figures out, we're just going to carry them over separately to the adjusted trial balance. And that looks really strange because an account can't have two balances, but you know, income summary doesn't show up on any of our financial statements. It'll eventually get zeroed out, but we keep them separate on our worksheet so that we can identify the beginning balance and the ending balance. The beginning balance is the first one, the ending balance is the second one. So now let's calculate our cost of goods sold using our worksheet. Our income statement always starts out with sales. So I can pick up my sales figure here from the adjusted trial balance and then back out the sales returns and allowances I had. I did not have any sales discounts, so we would not be subtracting those. Net sales then equals 135.2. So now we'll start the cost of goods sold calculation. That calculation starts with beginning inventory. So I will come up to my income summary account under the adjusted trial balance to find the beginning inventory. So the difference here and the cost of goods sold that we've calculated before is that we have two inventory figures. So we're going to bring down both the regular inventory beginning balance and the estimated returns inventory beginning balance. So if we add those two together, we have a total beginning balance of $25,000. So we're going to let that sit a minute and now calculate the cost of purchases. So during the year, I made purchases of inventory of $80,000, sent back $1,000, and had discounts of $500. So net purchases is $78,500. Now I have to add in the freight to get the cost of purchases. So I started the beginning of the year with $25,000 sitting in my store. I've purchased $79,200 more in merchandise. So all the goods I have available for sale total $104,200. Now I need to go and get the ending inventory so that I can calculate the cost of goods sold. I'll go to the same place, the income summary account, and this time I'm looking at the second set of figures. That's going to be my ending inventory for the regular inventory and the estimated returns inventory. So I'll enter the $27,000 and $3,000 and total those at $30,000. So if I had $104,200 to sell, and I've only got $30,000 left, that means my cost of goods sold is $74,200. In other words, this is the cost of the merchandise that I sold to my customers. Next, we'll look at the adjustment for customer refunds payable. Customer refunds payable are refunds to be paid to customers next year that resulted from sales that happened in the current year. So this adjustment corrects two accounts. It's going to correct the customer refunds payable liability account by showing what we really owe customers at the end of the year based on sales for this year. And then the sales returns and allowances is going to be updated and truly reflect the sales and returns and allowances based on the sales for the current year, that even though might be processed in the next year. So let's look at the example. Andy estimates that customers will be granted $4,000 in refunds of this year's sales next year. So the current balance is $2,600 in this account, and we need to bring this account balance up to $4,000. So that is a $1,400 increase. So customer refunds payable is a liability account. So we need to increase this liability, which we do with the credit because it's a liability, by $1,400. So that's going to bring up the account balance to $4,000. And then we're going to increase sales returns and allowances, because remember, the matching principle says that we need to match cost in the year they were incurred. So the sales result, the returns are resulting from sales from the current year, even though they'll be processed in the next year. So we're going to increase the sales returns and allowances account by $1,400. So with this adjustment, look at the current balance. You may be given a trial balance, and you'll have to look for the balance, and you'll either have to increase the balance or decrease the balance based on the current estimate. So in this case, we increased it and we had to credit customer refunds payable. If we wanted to decrease it, we would credit customer refunds payable. Next is the adjustment for unearned revenue. Unearned revenue occurs when a company receives cash or payment in advance before delivering the product or performing the service. And this happens a lot with sporting events or for plays or for concerts. The company promoting the event will sell tickets in advance, and all those ticket sales are unearned until the concert or the sporting event happens. So in this example, we have the Brown County Playhouse. They sell season tickets. Tickets sell for $50 each, at a maximum of 1,000 seats can be sold, and all the tickets are sold. So $50 at 1,000 seats is $50,000. So this company has collected $50,000. So upon the sale of those tickets, we're going to debit cash and credit unearned revenue. Typically when we sell something, we'll debit cash and credit sales or credit some other kind of revenue like services. But since we have not performed a service or delivered the goods yet, we're going to enter the revenue in unearned revenue. If something happened, if the sporting event or the concert never happened, we would have to refund the money. So instead of going ahead and taking it into sales, we're going to take it into unearned revenue, which is a liability account, because we're going to have to refund that if we don't deliver our side of the bargain. Then at year end, an adjusting entry is needed to recognize the ticket revenue that was actually earned during the year. So the problem tells us that 3 shows at 1,000 tickets at $10 a ticket was earned. So we have earned $30,000, and that means that we need to take $30,000 out of the unearned revenue liability account and enter it into a revenue account. So to do that, we're going to debit unearned revenue to lower the amount in our liability account, and then credit revenue to record the revenue that was actually earned. So with the unearned revenue, you need to know the journal entry to actually record unearned revenue and then adjust unearned revenue at the end of the year. Supplies expense is actually a repeat. We have seen this adjustment before. It says the supplies account shows a balance of $500, which means we purchased $500 in supplies during the year, and we set those up as assets. And then at the end of the year, we performed a physical count and found that we only have $50 remaining in supplies. So if we started with 500 and we only have 50 left, that means we used up 450 in supplies. So to indicate we used that up, we're going to debit supplies expense for the amount used, and we're going to credit supplies to bring that $500 balance down to $50. We're going to credit supplies for $450. And then here is the insurance adjusting entry. It says during the year $1,200 in prepaid insurance expired. Expired means it was used up, so that needs to be recorded. We're going to record the amount that we used up as a debit to insurance expense for $1,200 and then a credit to prepaid insurance. To record depreciation, we debit depreciation expense and credit accumulated depreciation for the amount of depreciation calculated on an asset. And then the last adjusting entry we'll look at is for wages. At year end, $650 in wages were earned by employees but not paid. So we're going to debit wages expense for the $650 that was earned but not paid. And then we're going to show that we owe those wages with a credit to wages payable for $650. Next, we will look at perpetual inventory adjustments. Now, these are different from the adjusting entry under the periodic method that we looked at earlier. The perpetual inventory adjustment is really just an adjustment to make a correction to our records. Remember, the merchandise inventory account is constantly being updated. When we purchase inventory, merchandise inventory is increased. When we sell inventory, merchandise inventory is decreased. So it's constantly being adjusted, and it should be pretty much right. But we are going to take a physical inventory just to make any minor corrections for errors, theft, breakage, or spoilage that probably occurred. So any difference that's found between our records and our physical inventory, we make an adjustment to correct those. So the difference, any difference we find, goes into the inventory short and over account. Okay, in our example, we have a physical inventory that shows $37.10 worth of merchandise, but our inventory account in our books says $38.40. So we need to make an adjustment to bring our merchandise inventory from $38.40 down to its actual amount of $37.10. That's a $130 difference. So if we're going to decrease merchandise inventory by $130, we need to credit the asset account merchandise inventory by $130. And then we will debit inventory short and over. In the next example, it says we have a physical count that shows $3,900 and merchandise inventory has, on our books, has $38.40. In this case, we're going to have to increase our merchandise inventory account by $60. So to increase an asset, you debit it. So debit merchandise inventory for $60 and then credit inventory shorten over for $60. And I think that is going to take care of our adjustments for Chapter 14.